how much should I be looking at for a mortgage payment? We're going to answer that question and a lot more next. Hey, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, real estate, and interest rates. So we're going to dive into those interest rates first. The average 30-year fix, according to Freddie Mac, at 5.23. I've got a link below to the weekly chart that Freddie Mac puts out. While you're down there, hit that like button, hit that subscribe, click that bell icon to be notified as I'm putting out weekly videos on the channel. So one of the first things that I want to do is kind of review where interest rates have been. And as we all know, rates have been going up unless you've been underneath a rock for the last, say, 4 to 5 months. But let's put it in perspective. And what I'll do is I'll put a little chart right here. And basically what I'm showing you here is the average 30-year fixed as of the first week of January as compared to the average 30-year fix the first week of June. So you can see that payment, basically $1,300 for a $300,000 mortgage, that's just principal and interest, is now $1,653. Now, the reason I show you this is not to scare you, but moreover, my number one tip for a buyer is to understand what is the monthly payment. Focus on the monthly payment to ensure you're getting good value for the property based on what that monthly liability that's tied to it, right? Now, again, this is just principal and interest. You've got taxes, insurance, other things. Speak with the lender and they'll give you a full kind of overview of what that monthly payment would be. But obviously that payment is higher. We're up basically 2% over the first 5 months of the year, 2.01%. So basically 2% over that period of time. Now, what we want to focus on today is how much you should, not can, but should be looking at. And my rule of thumb for buyers is to ensure that they are looking at this from a budget perspective and not overextending themselves, is 1/3 of your gross income, right? 1/3. So if the household makes $9,000 per month, then you want 1/3 of that gross income to go towards the principal, interest, taxes, insurance, and that's a $3,000 payment. Now that equates to different purchase price amounts in different markets, but that's the best budgetary kind of view that I can give you, is 1/3 of the gross income should be going towards the property. Right? And that leaves the rest of it to taxes, to saving for retirement, for utilities, for other things like that. So 1/3. Now, how much can you potentially afford? That is potentially 1/2 of your gross income that you could be looking at as a monthly liability tied to that property. Now again, that's all debts that you want to kind of equate to being 1/2 of the gross income you potentially could get qualified for. So that's today's lesson. That's what we wanted to review. What should you look at is roughly 1/3 of the gross income. Give you a quick update on rates, where rates will go. I'll link above to a couple more videos on my predictions in terms of where rates have been and where they're potentially going. But the trend has definitely been up. So stay informed, click that subscribe button, and we'll see each other again very, very soon.